Welcome to Truth Behind History. Today we are diving into Friedman versus Mises, rules, discretion, or gold, and why the way a society designs its money quietly decides winners and losers for decades. In this episode, you will see what sound money is trying to fix, why Ludwig von Mises argued for hard anchors that sit outside politics, why Milton Friedman championed simple rules for fiat money, and how incentives, time inconsistency, and the limits of centralized knowledge shape real outcomes over time. Start with the problem. Economies are noisy, information is scattered, and prices are supposed to translate that messy reality into signals people can actually use. When money itself becomes unpredictable, those signals blur, planning horizons shrink, and booms and busts get amplified rather than smooth. Sound money is simply an attempt to keep the measuring stick from warping. Mises' answer is to bind that stick to something no committee can vote to change tomorrow, like a commodity standard or strict convertibility, so that political discretion cannot quietly redistribute wealth through surprise inflation or credit manipulation. In his view, market prices and profit and loss discipline are the only reliable editors of economic truth. Friedman's answer accepts modern fiat but tries to disarm discretion with rules, aiming for a steady, predictable path for the money supply so that expectations settle and people can plan without guessing the mood of a committee. The rule is a speed limit for money, not a steering wheel for everything else. Both approaches are responses to the same realities. The knowledge problem, where no central authority can know local facts in time to micromanage outcomes, and the incentive problem, where short-term political gains tempt long-term monetary drift. So the core question on this slide is not abstract at all. Do we trust a hard external anchor to enforce discipline automatically, or do we trust explicit, transparent rules to make a flexible system behave as if it were anchored? Each path changes behavior in predictable ways. Anchors maximize credibility, but can feel rigid when shocks hit, while rules preserve flexibility, but only work if institutions resist the urge to deviate when this time is different. Keep that frame in mind as we move forward, because once you see money as a commitment device, you start to notice how much of economic life depends on whether that commitment is believable. Picture a long corridor of monetary experiments where each door is labeled with a date, and as we walk through, we can feel how convertibility kept slipping out of politicians' hands. The classical gold standard in the late 19th century was a fairly tight promise. Currencies defined by a weight of gold, and the point was discipline rather than magic, because when a country spent more abroad than it earned, gold flowed out and prices had to adjust, or the peg would snap. But then came the First World War and the bill for total mobilization, and suddenly many governments suspended convertibility to print for guns and wages. After the guns fell silent, they tried to go back, but not to the world they left, and that mattered. The interwar gold exchange standard was a looser hybrid, with key currencies pegged to gold and others pegged to those key currencies, which meant discipline was now mediated by politics and central bank choices rather than an automatic price specie flow. Britain's return to gold at an arguably overvalued rate strained its industry. France accumulated gold and sterilized inflows. And pressures built until Britain quit gold in 1931 and the United States devalued in 1933, redefining the dollar's gold price and signaling that the convertibility promise was alterable under stress. In 1944, Bretton Woods tried a new compromise. The dollar would be as good as gold for foreign central banks at a fixed rate, and everyone else would be as good as the dollar, hoping to marry stability with post-war reconstruction. It worked while confidence was high and capital controls blunted speculative flows. But as the post-war world opened, trade surged, U.S. fiscal and external deficits widened, and the pool of official dollar claims kept growing faster than the U.S. gold stock, creating a slow arithmetic problem that no communique could wish away. By the late 1960s, the London gold pool collapsed. A two-tier market emerged, and central banks quietly realized that defending the old parity required either painful domestic tightening or a public break with the promise. In August 1971, the United States closed the gold window, ending official convertibility and ushering in the era of modern fiat and discretionary exchange rate management. The causal chain on this slide is simple to state and hard to escape. Where finance and political priorities put stress on pegs, partial Politicized anchors bought time, but not credibility. The arithmetic of growing claims versus finite gold forced a choice. The choice was to break convertibility and accept a system where rules would have to be written rather than mined. To see Mises clearly, start where he starts, with money as a market-grown institution rather than a decree, and value explained by marginal utility, the simple idea that the next unit of a good matters less than the first because our most urgent wants get satisfied first. That lens tackles the chicken and egg problem of money's purchasing power through the regression theorem, which says today's money price makes sense because yesterday's money had purchasing power, and if you keep stepping back in time, you eventually reach a point when the thing that became money had non-monetary uses that people already valued, such as a commodity with independent demand. So the circle is broken by history rather than by assumption. Once money exists, prices become a high-bandwidth summary of dispersed knowledge, telling producers which projects to advance and which to abandon. But that guidance system depends on the interest rate, conveying real intertemporal information about how much genuine saving society is set aside, when policy or banking practice pushes the market rate below the natural rate implied by voluntary saving. Entrepreneurs read that low rate as a signal that more resources are available for long, roundabout production processes than actually exist, and they lengthen supply chains, expand capacity, and start projects that look profitable under cheap credit but will not be supported when credit conditions normalize. That is the heart of the Austrian business cycle mechanism as Mises frames it. Not that investment is bad, but that mispriced credit distorts relative prices and the structure of production, pulling resources into patterns that cannot be completed without ever accelerating money and credit. So the eventual slowdown reveals malinvestments that must be revalued or liquidated. The policy implication he draws is spare and severe. Keep money as far from political discretion as possible, either by anchoring it to a redemption commitment that cannot be casually changed or by allowing competitive issuance under strict convertibility and market discipline, so that surprise inflations and credit tricks cannot quietly rearrange wealth and mislead decision makers. In other words, let the rules of exchange emerge from voluntary contracts and arbitrage, and let profit and loss, not administrative optimism, decide which plans survive. Friedman picks up the story from the banking trenches of the early 1930s and asks a blunt question. If money is the economy's oxygen, why did the central bank let the room run out of air? In the Monetary History with Anna Schwartz, he shows that what began as a normal downturn turned catastrophic when bank failures, cash hoarding, and policy passivity caused the quantity of money to collapse, shrinking incomes and spending in a grim spiral. And the cure he draws from that autopsy is not to micromanage everything, but to keep the oxygen steady. His proposal is disarmingly simple. Accept modern fiat money, but bind it with a clear rule for steady growth in the money stock, something like a low single-digit path that roughly matches long-run real capacity, so that people's expectations can settle and planners, savers, and borrowers are not forced to second-guess the mood of a committee. In that world, the central bank is less a pilot yanking the joystick and more an autopilot keeping altitude. The logic rests on a few clean ideas he hammered home. Money is not neutral in the short run, so abrupt changes in its growth rate whipsaw output and jobs, but money is neutral in the long run. So try to buy permanent prosperity with faster printing only purchases inflation. Expectations matter, because if people learn to anticipate policy surprises, those surprises stop working and you are left with the inflation without the boom. He also worries about time inconsistency. The temptation for policymakers to promise prudence today and then chase short-term gains tomorrow, which is why he prefers rules that are transparent, testable, and boring. Do the same thing every period, publish what you are doing, and let markets do the rest. Even his view of a lender of last resort fits the rule-bound theme. In a panic, supply liquidity freely against good collateral to stop solvent institutions from failing due to a scramble for cash, but do it within a framework that prevents the crisis tool from turning into a peacetime subsidy. In short, Friedman is not asking us to worship a money aggregate or a model. He is asking us to recognize that predictable policy can make a flexible fiat system behave as if it were anchored, and that this predictability is the cheapest form of insurance an economy can buy. If you want the heart of this debate in one place, it is this: who actually knows enough to guide millions of strangers, and who has the incentive to be honest about what they know? Mises and Hayek argue that knowledge lives in fragments, on loading docks, in shop floors, and quiet spreadsheets, and that prices act like compressed messages broadcasting those fragments to anyone who needs them, while profit and loss are the grading system that rewards plans that fit reality and flunks those that don't. Centralized discretion weakens that feedback loop because it replaces the exam with an opinion. The signals get blurred by good intentions, lobbying, and wishful thinking. Friedman, coming from a different toolkit, still concedes the same limits. Even smart committees cannot gather or process local facts in time, which is why he prefers simple, published rules that require almost no private information to implement. Then there is the incentive problem, the old-time inconsistency trap. Promise discipline today, chase short-term gains tomorrow, and hope no one notices. Rules try to tie the policymakers' hands, while market anchor tries to take the hands off the lever entirely. Both camps are therefore trying to engineer credibility, just with different devices. One outside the political system via convertibility or competitive issuance, the other inside the system via an algorithmic path for money, so transparent that cheating becomes costly. If you like metaphors, think of it this way. The anchor is a seatbelt that locks on impact, while the rule is the painted line that keeps you centered. Both reduce the odds of a crash, but they work through different channels. One by removing discretion at the moment of temptation, the other by lowering the temptation in the first place. Think of the interwar years as a stress test where two different diagnoses look at the same patient and see different vital signs. On one side, the gold exchange standard of the 1920s tried to rebuild the pre-war world with pegs that were politically chosen rather than economically earned. So when Britain pegged high and others like France sterilized gold inflows instead of letting prices adjust, the automatic pressure release of the classical system was muted. Credit conditions stayed easy in some places, capital chased yields and parities, and the structure of production stretched in ways that only made sense under those distorted signals, which is exactly the kind of cycle Mises warned about. When strains finally broke the weakest links, sterling off gold in 1931, the United States devaluing 2 years later, the unwind was painful because projects greenlit by cheap credit and misaligned pegs no longer penciled out once the cushions vanished, and the liquidation exposed malinvestment that had been disguised by the flow of new credit. Friedman, looking at the same timeline, points to a different lever moving the same needle. As banks failed and depositors fled to cash, the quantity of money contracted sharply, and the central bank, guided by doctrines that dismissed broad money in favor of short-term rates, failed to supply enough high-powered money or to act as an aggressive lender of last resort. The result was a collapse in spending that turned a garden-variety downturn into the Great Depression. In this reading, the depth of the contraction is not explained by pegs alone, but by the arithmetic of a vanishing money stock and the absence of a credible backstop. Had authorities expanded the base and stabilized the banks, output could have fallen far less even as exchange rate regimes shifted. Two frameworks, one patient. Either way, the lesson is that the institutions you choose, convertibility rules, sterilization practices, and the posture of the central bank in a panic, determine whether imbalances deflate gradually through relative price changes or implode suddenly through a monetary choke. The 1970s are what happens when a money system loses its anchor and then tries to steer with politics. After the gold window closed, the promises had to be written rather than redeemed, and into that new fiat world crashed two oil shocks, first in the early part of the decade, and then again near its end, which acted like a tax on energy-intensive life and rippled through every supply chain. The temptation was to treat rising prices as a series of bad actors rather than a coordination problem. So governments experimented with wage and price controls, trying to freeze the thermometer to cure the fever. Producers responded by shrinking quality, delaying investment, and finding side doors, while queues and shortages did the rationing that prices used to do in plain view. Expectations, meanwhile, slipped their moorings, Once households and firms learned that tomorrow's dollar bought less than today's, they bargained and budgeted as if inflation would continue. The Phillips curve shifted, and the old trade-off between unemployment and inflation turned out to be a moving target. Through Mises' lens, this was predictable. Politicized money plus administrative caps on prices blurs the signals entrepreneurs need, so the economy stumbles forward with a faulty compass, consuming capital and mistiming projects. You get the worst of both worlds, rising nominal magnitudes with real disarray underneath. Through Friedman's lens, the pattern snaps into focus as a monetary phenomenon layered onto real shocks. Sustained faster growth in money to cushion recessions and finance deficits lifts the overall price level, while adaptive expectations make each attempt to buy a little extra employment increasingly expensive in inflation points. When people come to expect higher money growth, they demand compensation up front, and a surprise that once worked to boost output stops working, leaving only higher inflation behind. The result was stagflation, a word that sounds like a contradiction until you realize that misaligned incentives can slow real activity even as nominal prices climb, and a practical lesson emerges from the decade's cluttered charts and frustrated headlines. When the measuring stick keeps stretching, contracts become guesses, planning horizons shorten, and the social conversation about value gets louder but less informative. When Paul Volcker took the chair in the late 1970s, he did something that only sounds technical but felt like an earthquake in real life. He stopped trying to steer the economy with small, frequent tweaks and instead yanked the anchor chain on money itself, letting interest rates go where they had to in order to choke off inflation, and signaling that the regime had changed from comforting words to measurable discipline. The result was a brutal pair of recessions, shuttered factories, painful unemployment, and mortgage rates that made ordinary families feel like the arithmetic of adulthood had turned against them, yet that very pain communicated something no speech could. Policy would not retreat at the first sign of discomfort. As expectations bent downward, long bonds began to trust again. Wage bargains stopped building in double-digit cost of living escalators, and businesses could make multi-year plans without assuming tomorrow's dollar would be worth much less than today's. In that sense, the episode vindicated Friedman's focus on credibility and rules, because once markets believed that money growth would stay restrained, the economy earned a decade of lower and more stable inflation. But look closer, and you also see Mises' warning about the hangover after a long credit party. Projects that only made sense under artificially cheap financing had to be written down or abandoned, balance sheets were repriced, and capital-intensive sectors took the brunt of the adjustment, not because investment is bad, but because the earlier signal had been wrong. The deeper lesson of this slide is moral as well as mechanical. Re-anchoring a money system is costly in the short run, but cheaper than living indefinitely with a broken compass. And credibility, once purchased at a high price, becomes a kind of public infrastructure, quiet, invisible, and essential for everything else to work. The period from 2008 to 2020 is like watching the monetary safety net get stress-tested in slow motion and then at full speed. First came the global financial crisis, which was not just about bad mortgages, but about the plumbing of modern credit markets, where banks and shadow banks funded long assets with very short promises. So when trust cracked, wholesale funding vanished overnight, repo haircuts jumped, money market funds broke the buck, and the scramble for cash threatened to turn balance sheet problems into a full monetary contraction. The response was a blend of lender of last resort and experimental medicine, with the central bank expanding its balance sheet, buying safe and then riskier assets, and opening liquidity facilities to stop solvent institutions from failing simply because the oxygen of cash had thinned. Interest rates hit the lower bound, so policy leaned on forward guidance and asset purchases to shift expectations and portfolio choices, nudging investors out the risk curve and trying to keep nominal spending from falling through the floor. It stabilized the patient, but it also left a footprint in asset prices and in the incentive to lever cheaply. Then the pandemic arrived like a meteor. Supply chains seized, services shut, and a synchronized fiscal and monetary surge attempted to bridge incomes through the pause, with direct transfers, credit guarantees, and another rapid expansion of the central bank's balance sheet. that kept markets from freezing at precisely the moment households and firms needed cash most. In the short run, that combination worked as triage. But as demand rebounded into supply constraints, price pressures built. Through 2021 and 2022, revealing how quickly expectations can reprice when the flow of money and credit outruns the ability to produce goods and services. Through a Misesian lens, years of very low rates and crisis backstops risked misallocating capital toward projects that only pencil out under cheap finance. So the later adjustment would be uneven. Through a Friedmanite lens, the sequence reads as a reminder that keeping the path of money growth and expectations predictable is the surest way to avoid whipsawing output on the way down and inflation on the way up. Either way, this slide asks a practical question rather than a doctrinal one. When the tools that stop a panic become normal for long stretches, how do we preserve the benefits of stability without teaching the system to take risks that only make sense if the safety net is always there? Choosing between rules, gold, or hybrids is really about choosing where discipline lives and how temptation is handled when the world throws a curveball. A classical gold or commodity standard puts discipline outside the political system by tying money to a redemption promise that cannot be changed without an obvious break, which historically limited seigniorage and forced fiscal honesty. But it also meant that real shocks and changes in money demand had to be absorbed through wages and prices, a process that could be slow and painful. A K% rule or an NGP level target stays within fiat but tries to make it behave as if it were anchored by publishing an algorithm for policy that everyone can understand and verify, trading some automaticity for measured flexibility. The risk is measurement error, model drift, or the perennial temptation to deviate just this once when unemployment rises or elections loom. Currency boards and free banking sit in the hybrid family. A currency board imports an anchor by requiring full reserve backing in a foreign currency at a fixed rate, which delivers credibility quickly, but also imports someone else's monetary policy and limits the crisis toolkit. While competitive note issue under convertibility lets market arbitrage enforce discipline across issuers, historically rewarding the well-run and punishing the reckless, but demanding a legal framework that allows failure without panic. The design question is not abstract. Each regime decides which margins move in a storm, prices, quantities, or parities, and who absorbs the adjustment costs first, whether as borrowers, savers, taxpayers, or export sectors. History suggests that systems with clear commitment devices produce longer planning horizons and calmer inflation expectations. Yet the specific device matters for where stress reappears, in the exchange rate, in unemployment, or in the budget. If you think of money as a contract the whole society signs, the question on this slide becomes simple to ask and hard to answer. Do we want a contract enforced by convertibility, by a published rule, or by competition among issuers? Each has worked, and each has failed, but in every case the failures line up with moments when the commitment stopped being believable. This is where numbers meet norms. Every monetary regime decides, often silently, who absorbs the hit when reality changes, and it rarely does so evenly. With a hard anchor, prices and wages must do more of the adjusting, which can feel harsh in the short run for workers and indebted firms, while savers and long-horizon planners gain from a unit of account that does not drift, but with discretionary fiat. Surprise inflation can flip the winners and losers, transferring wealth from creditors to debtors and from fixed-income retirees to borrowers without a single recorded vote. Consider the path of new money when policy expands rapidly. It does not land everywhere at once. It arrives through particular balance sheets and budgets. So early receivers spend at yesterday's prices while later receivers face tomorrow's, an uneven ripple historians call the Cantillon effect, and that path matters for fairness as much as for efficiency. Rules and anchors do not eliminate redistribution, but they make it harder to do by stealth. To change purchasing power in a rule-bound system, you must debate it in the open or change the rule itself, which is costly and visible, whereas wide discretion lets policy reassign claims through the price level or credit channels with little formal process. There is also a question of agency hiding here. In a system where relative prices are allowed to move and people can respond quickly, Shopkeepers, builders, and nurses act on local facts without waiting for permission, and the gains and losses that follow feel like the result of choices. In a system that leans on ad hoc controls or episodic surprises, the same citizens become petitioners, spending more time navigating approvals and less time solving problems. The moral stake is not whether someone pays. Someone always pays, but whether the mechanism is predictable enough that people can consent to the risks they bear and dignified enough that adjustment happens through voluntary exchange rather than administrative favors. Here is the uncomfortable part, where evidence refuses to flatter anyone's theory. When you look across long stretches of data, countries that credibly restrain money tend to show lower inflation variance and calmer bond markets, and that lower variance coincides with longer planning horizons, deeper capital markets, and more patient investment. Yet the same evidence also whispers that rigid anchors can be brittle when real shocks hit. Think about the quiet stability of Bretton Woods while capital controls and convertibility discipline held, the later calm of inflation targeting with independent central banks during the Great Moderation, and currency boards like Hong Kong's that preserve trust during storms. In each case, credibility lowered the background noise so businesses could plan, and the price of money stopped rewriting contracts every quarter. Now hold that against episodes where the anchor met a stubborn real shock or a political break. The exchange rate crises of the early 1990s, or Argentina's peg snapping under debt and terms of trade stress, or even commodity-heavy economies trying to adjust with sticky wages. Here, the same credibility that kept inflation quiet sometimes forced adjustment through unemployment and output rather than through the price level, because the anchor made some margins slow to move. Empirically, the pattern is subtle. Credibility matters, but the mechanism you choose decides where the stress goes when reality changes, into prices, into quantities, or into the exchange rate, and that choice shows up in who bears the brunt. Methodologically, it is hard to separate cause from correlation because institutions, laws, and expectations co-evolve with policy regimes. Still, the broad pictures are consistent over and over again. Where discipline is believable and transparent, money stops being the story and becomes the backdrop. Where the commitment is soft or ambiguous, the variance creeps back in, and so does the temptation to manage outcomes with surprises. The challenge this slide puts on the table is not to pick a team, but to read the map honestly. Stable rules seem to buy quieter inflation at the cost of sharper real adjustments in certain shocks, while discretion can cushion some shocks at the cost of noisier prices and shorter planning horizons. Pick your mechanism, pick your margin, and know in advance who will carry the weight when the tide turns. Look ahead through the lens of commitment, and you start to see practical levers rather than abstract slogans. One lever is statutory rules that are simple enough to publish on a postcard and hard enough to change that politicians think twice, like a clearly defined path for money growth or for nominal income that gets reported each quarter with a scorecard. Another is automaticity, where emergency tools switch on and off by pre-announced triggers, paired with sunset clauses so that what is extraordinary cannot quietly become ordinary. A third is convertibility in some form, not necessarily to metal, but to liabilities that impose market discipline on issuers, so that creating new claims requires taking visible balance sheet risk. Transparency is its own discipline. If a central bank explains its reaction function in plain language, shows its balance sheet in a way non-specialists can read, and commits to publish when it deviates and why, it raises the reputational price of drift. Guardrails help too, like requiring elected approval for quasi-fiscal programs, setting clear limits on buying private assets in peacetime, and spelling out exactly how losses are handled so that fiscal dominance does not sneak in through the back door when debt is high. Then there are the stress lines themselves. Heavy public and private debt can turn interest rate policy into a political question even when no one intends it. Election calendars tempt the just this once exception, and global payment architectures are shifting as new rails appear. From dollar-based systems and currency boards to stablecoins that promise convertibility and to central bank digital currencies that promise convenience, but also raise hard questions about privacy, programmability, and the boundary between monetary policy and social policy. The key is to evaluate these rails with the same yardstick we use for everything else in this series. What incentives do they create? How do they allocate adjustment costs when shocks hit? And how believable is the commitment over time? A digital form of cash that preserves anonymity and offline resilience acts like a public good, while a programmable currency with open-ended policy hooks could become a tempting instrument for off-budget interventions. Indicators worth watching are not glamorous, but they are telling. Does the stated rule survive the next recession without temporary exceptions that never expire? Do long bond yields and break-even inflation measures calm down as credibility rises? Do stablecoin pegs hold under stress without hidden backstops? And do emergency facilities actually roll off on schedule? None of this decides the debate, but it does give you a field guide for spotting when a system is binding itself to reality versus learning new ways to make promises it may not keep. Step back for a moment and notice the quiet agreement beneath the argument. Both Mises and Friedman were hunting for the same prize, a credible way to keep policy tethered to reality so that prices can speak clearly and plans can survive contact with tomorrow. The disagreement is less a fight over goals and more a choice of handcuffs. Whether to fasten money to an external anchor that resists political moods, or to bind a fiat system with rules so plain and predictable that breaking them is costly in public. That means the real decision is not binary, but constitutional. Which commitment device do we trust? Who holds the leash when trade-offs bite? And how visible is the cost of changing course? And underneath the mechanics sits a moral question that societies answer whether they admit it or not. Should the purchasing power in your pocket be a political variable that can drift with emergencies and elections, or a contractual promise that changes only by explicit, argued choice? History's pattern is blunt here. Credibility is scarce, slow to build, and easy to squander, and when it erodes, adjustment happens anyway, just more painfully and less fairly. If this sharpened how you think about money, incentives, and responsibility, tap like to help others find it. Drop a comment with the anchor or rule you would choose and why, and subscribe to Truth Behind History for more episodes that dig into the past with rigor and personality. If you enjoy thoughtful, entertaining history that lets the evidence speak, explore our other videos next, and keep the conversation going.